US population is getting older and they're living longer, and we really need to reassess how much income we need for retirement and what kind of investment options we have. And equities should be an important part of that investment strategy, and especially the dividend payers. There are roughly 79 million baby boomers that are going to be retiring, and roughly 70% of those do not have enough income to retire on, and they're actually working longer to be able to supplement that income. They've seen not only their retirement accounts fall in value, but they're also seeing their home prices and other investments lose value also. That's why we believe investing in dividend payers and dividend growers should be a fundamental part of your investment strategy to build wealth over a long period of time and really protect your nest egg. Dividends allow you to have current income to live on, and dividend growth allows you to offset some of the increasing costs, such as inflationary costs, interest rates costs, and rising healthcare costs in the future. And of course, dividend reinvestment allows wealth building over a long period of time. Investors have seen extreme amount of volatility over the last decade, and they have lost confidence in capital appreciation alone to grow their nest egg, to grow their retirement. Currently, investors don't have that many income-producing options available to them thanks to the 0% interest rate environment. And that's why in the future, dividends will become an important part of any investment portfolio. Dividends are primarily a product of successful companies with strong cash flow, strong balance sheets, and strong franchises. When companies pay a dividend, it imposes a financial discipline on management, and dividend growth allows prudent investing for future. In the longer term, investing in dividends is going to be an important part, a key part of any investment strategy. Of course, you can supplement that income in addition with investing in REITs, preferred or converts as a diversified portfolio and a complement to dividend yielding strategies. If we look at the performance of dividend payers since the 1970s, they have actually outperformed their non-dividend paying counterparts. And certainly equities relative to other asset classes do tend to outperform during rising interest rate environments. S&P 500 yields around 2% at the moment, with roughly a 30% payout ratio. Over longer term, this has really been at more in a 4% range with a 50% payout ratios. Given the investors are becoming a lot more prudent about their investing and wanting less volatility, we do expect that companies to raise their dividend at a much faster pace, and for the S&P 500 yield to go back to more normalized levels. And that in itself will allow dividend payers to keep pace with changing economic conditions. We still believe that inflation is likely to be contained within the 1% to 3% range. However, there is that fear that higher raw material prices will create more inflation out there. And certainly, if we look at the gasoline prices or food prices, it's impacting all of us immediately, and especially those on a fixed income or on lower budgets. Inflation can erode your savings surprisingly fast, and that can also impact your purchasing power and your savings and other investments. That's why we believe that in a diversified portfolio, you should have investments that are growing, such as the dividend growers, to be able to offset the impact of those higher rising inflationary costs. And certainly in certain decades like 1970s or even further back, 1940s and 1950s, dividend payers have actually outperformed during those inflationary periods. If investors are concerned about interest rates, higher inflation, downside protection, or volatility, they should really think about dividends as a cornerstone of a very diversified portfolio.